Stop! Before you book your flight, sell your property, or file your next tax return, you need to hear this. Every headline is creating confusion. Is that 5-year tax holiday real? What is the new final deadline for delayed filings? What are the new baggage limits? And how can one small missed form lead to massive penalties? The Union Budget 2026 is not just another policy announcement. It is a fundamental rewiring of the rules of non-resident Indians. In this video, I am diving into 7 major changes that directly impact NRI finances. The 5-year tax holiday, new timelines for belated returns, the foreign asset disclosure scheme, TAM-free property sales, lower TCS on overseas travel and education, MAT relief for NRIs, and the 2026 baggage rule overhaul. Use the chapters below to jump straight to what matters to you. If you are an NRI, this video is your essential non-negotiable guide. I am breaking down the biggest changes in tax, customs and compliance and giving you a clear practical checklist to navigate the new Indian landscape safely. Hi, my name is Sagar and welcome to another episode of the Offshore Advantage. Let's break down the Union Budget 2026 from an NRI perspective. 5-year tax holiday for specified NRIs. First, let's take a look at a headline that is creating a lot of confusion in the NRI circles. You may have seen something like NRI professionals visiting India will get a 5-year tax exemption on overseas income. Now that sounds like a blanket benefit for every NRI who comes to India. It is not. This budget proposal is narrow, technical and conditional. And if you treat it like a free pass, you will land yourself in the exact situation you were trying to avoid. So let me break it down in simple language. Think of Indian tax like a switch. When you are a non-resident, India generally taxes you mainly on income that is linked to India. But when you become a resident, the tax system can start looking at your global income as well, depending on your status. Now here is the practical problem the government is trying to solve. Sometimes an overseas professional comes to India for a specified assignment. Their stay becomes long, they can cross the residency day threshold, and suddenly they worry that their overseas income will start getting pulled into India taxation. Budget 2026 proposes a relief for that situation, but only for a specific category of people. Let me tell you exactly what it is. This is proposed as an amendment through the Finance Bill 2026. It applies from 1st April 26 onwards, meaning tax year 26-27 onwards. Now, what is the actual relief? If you qualify, then for up to 5 consecutive tax years, certain foreign income will not be taxed in India. But please listen carefully. It is only foreign income that genuinely accrues or arises outside India and which is not deemed to accrue or arise in India. That phrase is important because it is the legal boundary line. Now, who can qualify? There are 3 key conditions you should remember. First, the person should have been a non-resident for 5 consecutive tax years immediately before the tax year in which they first come under the arrangement. Second, the visit to India must be for rendering services in India in connection with a scheme that is notified by the central government. This is not a casual visit. This is not I came to India to consult for a client. It must be linked to a government notified scheme kind of a situation. Third, the exemption runs for 5 consecutive tax years starting from the first year in which the person comes to India under that notified scheme. Now, one more important point, the law also says the relief will be subject to conditions that may be prescribed later. So the government can still notify detailed rules, documents and compliance conditions. Which means as of today, you should not assume that you can claim this just because you are an NRI and you are visiting India. The notified scheme is the gatekeeper, no scheme, no entry. Now let us address the biggest misunderstanding I am seeing. People think if I come to India and my salary is paid abroad, then it becomes foreign income. That is not how Indian tax law works. The source rules matters. If you are physically working in India and rendering services in India, the income can still be taxed as India linked or deemed India sourced, even if the money hits your foreign bank account. So this budget does not make India linked salary magically tax free. What it protects is foreign sourced income that is truly outside India. For example, foreign dividends, foreign interest, foreign rental income, foreign capital gains on overseas assets. Again, only where it is genuinely foreign sourced and not deemed to be India sourced. So now why is the media calling it NRI professionals visiting India? Because it is easier to write headline that way. But legally, that is not the wording. Legally, it is targeted at specific non-resident individuals coming to India for services under a government notified scheme after being non-resident for 5 years. So if you are an ordinary NRI who comes to India for a personal visit or a business visit or even to explore opportunities, this provision is not automatically for you. Now let me add one more caution. The law uses language like visits India for the first time for rendering services in connection with a notified scheme. Until clarifications come out, do not casually assume that past India visits are irrelevant. In practice, this will have to be interpreted carefully based on the scheme notification and the future rules that will apply. So what should you do if this sounds relevant to you? Here is a simple practical checklist. Number 1, check your residential status history. Were you non-resident for 5 consecutive tax years? Number 2, check whether your engagement is actually under a central government notified scheme, not a company program, not an industry initiative, a government notified scheme. Number 3, identify the income you want to protect. Is it truly foreign sourced and not deemed India sourced? Because India linked income is still India linked even if paid abroad. Number 4, track the 5-year window properly. It is 5 consecutive tax years from the first qualifying year under that scheme. And number 5, wait for the notified conditions and documentation requirements, because that is where the compliance will sit. So here is the clean takeaway. Budget 2026 proposes a 5-year tax exemption only for certain foreign sourced income for certain non-resident professionals coming to India under government notified schemes, subject to prescribed conditions, effective from 1st April of 2026. So don't treat it as a general NRI holiday. Treat it as a narrow relief with a clear gatekeeper and clear boundaries. Belated return. The second major budget update for NRIs involves belated returns, giving you much needed extra time to get your filings in order. If you are an NRI and you have ever said this sentence, I filed my India return, but my foreign statements came late. Budget 2026 has a proposal that directly targets this pain point. Let me simplify it. Today, the revision window effectively ends on 31st December, meaning even if you discover a genuine mistake in January or February, you can't fix it through a revised return. Budget 2026 proposes to change that. You will get time to revise your income tax return up to 31st March. In simple words, earlier the edit window ended on 31st December. Now the edit window will run till 31st March. But here is the catch. It is not a free extension after 31st December. If you revise after 31st December, a late fee is proposed. And the fee is not based on how big is your mistake. It is based on your total income. If your total income is up to 5 lakhs, the proposed fee is 1000 rupees. If the total income is more than 5 lakhs, the proposed fee is 5000 rupees. So even if your correction is small, say you missed reporting some foreign bank interest, or your TDS credit got reflected late in Form 26As, or your capital gain numbers changed after a broker issued a corrected statement, the fee, if applicable, will depend on total income, not the size of the correction. Now let's address the question NRIs will immediately ask. Does this mean I can file late return up to 31st March? The answer is no. The proposal is about revising a return. It does not automatically mean the original due date has changed. It also does not automatically mean the belated return filing deadline has changed. It does not mean the Form 67 of foreign tax credit can be filed late. So please don't treat 31st March as a relaxed filing deadline. Think of it like this. The train departure time is still the same, but if you boarded and later realized your seat number is wrong, the railways are saying you have now time to correct the ticket up to 31st March. And if you do it after 31st December, you pay a small fixed charge. Another point, the proposal also says a revised return can be filed even if your original return was a belated return. Meaning, if you filed late but validly filed, you can still revise it within the extended window. Now, why does this matter so much for cross-border taxpayers? Because cross-border data rarely arrives on time. Examples I see in real life: a foreign broker gives a consolidated tax report late, A bank reissues an interest certificate, a capital gain statement gets corrected due to corporate actions, TDS entries appear late in Form 26AS or AIS, or you realize after filing that a particular income item was reported incorrectly. For an Indian resident, this is still manageable. For an NRI, this is very common. Because your India tax compliance depends on documents coming from multiple countries, multiple time zones, and multiple reporting cycles. So, extending the revision window till 31st March is logically helpful. It reduces panic. It also reduces rushed revisions, and it gives a realistic buffer for genuine correctness. But I want to be very clear about what this change does not do. It does not give you permission to be casual about the original return filing date. It does not fix loss carry forward conditions if the original return was not filed within the time were required. And it does not remove your responsibility to maintain clean reporting. It only gives you more time to correct genuine mistakes with a fee beyond 31st December. Now, one legal point stated plainly: this is a budget proposal. It becomes law only when the finance bill is enacted and the final text is notified and implemented on the portal. The intent is very clear, but the final operational details should always be checked from the enacted provisions and system implementation. So, here is the practical way I would advise NRIs to think about it. Try to finalize your return as early as possible. If you discover a correction up to 31st December, revise without the late revision fee. If you discover it in January, February, or March, don't ignore it, evaluate it. If it needs correction, revise, pay the applicable fee, and clean up the compliance. Because in cross border matters, small reporting mistakes become big headaches later. And if you are a higher income tax payer, remember the proposed fee can be 5,000 even for a small correction. So ideally do the reconciliation early. Form 26AS and AIS, capital gain statements, foreign statements that impact India reporting. And keep a system so you are not forced into last minute firefighting. This was the simple meaning of the Budget 2026 change on revised returns. More time till 31st March, but after 31st December, a fee. And for NRIs, that extra quarter can be the difference between a clean return and a messy correction story later. Fast DS 2026. Now for the third change, Fast DS. But before we look at that, let me clear one confusion because I get this question daily. If you are a non-resident, Schedule FA is generally not applicable to you. If you are RNOR, Schedule FA is generally not applicable to you either. Schedule FA is primarily a resident and ordinarily resident obligation because that is the category expected to disclose foreign assets and foreign income in their return schedules. So if you are still an NRI abroad or you are RNOR after returning, do not panic just because you have foreign assets. The trigger is not the asset alone. The trigger is your residential status and the year in which disclosure became applicable to you as a resident and ordinarily resident. Now, why is everyone so scared of this topic? Because the penalties for foreign asset non-disclosure can be extremely severe. Under the Black Money Act framework, non-reporting of foreign assets in the prescribed schedule is treated as serious non-compliance. It is not treated like a small clerical error. It can attract heavy monetary penalties, and in serious cases, prosecution provisions also exist in the law. And you would have seen this in real life. In December 2025, the Income Tax Department had to publicly guide taxpayers on how to report foreign assets while revising returns because many people who filed ITR 1 could not even see Schedule FA in the revision flow. Around the same time, a lot of taxpayers received alerts and advisories pushing them to correct foreign asset and foreign income reporting before the year end deadline, and it created a lot of panic and confusion. So, this is the context. People are not scared because they did something criminal. They are scared because one missed schedule, one wrong ITR form, one incomplete disclosure can suddenly feel like a legal landmine. Now, Budget 2026 has proposed a one-time compliance window to deal with a specific slice of this problem. The formal name is the Foreign Assets of Small Taxpayers Disclosure Scheme 2026. Many people are calling it FAST DS 2026. Now, here is the simplest way to understand FAST DS. It is a one-time time-bound cleanup window. You disclose certain foreign income or certain foreign assets, you pay what the scheme requires, And for what you validly disclose, the scheme offers a closure and a limited immunity framework under the Black Money Act for those disclosed items subject to conditions. Important points. This is a budget proposal introduced in the finance bill. It becomes operational only after enactment and notification. Budget papers describe it as a one-time 6-month window, but the exact start date and last date will be notified. So please do not guess dates, track the notified dates. Now let me explain the scheme in a way an NRI brain will grasp it easily. Think of fast DS as two separate lanes. One lane is expensive, one lane is comparatively lighter. The lane you choose must match your facts. If you try to squeeze into the lighter lane when your facts belong to the expensive lane, that is exactly how a declaration becomes unsafe later. Lane 1 is the expensive lane. This lane covers undisclosed foreign income and certain undisclosed overseas assets as defined in the scheme. Here is the key idea. This lane is not merely about I forgot to tick a box. This lane is about income that should have been offered to tax in India and was not, and about overseas assets where your source explanation is either missing or not acceptable. This lane is available only if the aggregate value of what you declare in this lane is within 1 crore rupees, and the payment structure is also very heavy by design. 30% tax on the value of the undisclosed overseas asset as on 31st March 2026. 30% tax on the undisclosed foreign income, and then an additional amount equal to 100% of that tax. So this lane is not a discount. It is a structured closure route, but at a steep cost. Now lane 2. Lane 2 is where returning NRIs usually relate, but only if they genuinely fit the lane 2 conditions. Lane 2 is for certain overseas assets that were not reported in the relevant schedule of the return, even though the acquisition is explainable in either of these two ways. 1. The asset was acquired from income arising outside India during the period when you were non-resident, but the asset was not disclosed in the relevant schedule when you became resident and filed your return. 2. The asset was acquired from income which was already offered to tax in India under the Income Tax Act, but the asset was still not disclosed in the relevant schedule. So lane 2 is basically this: the asset exists, the money trail may be clean, the failure is in the return schedule disclosure only. For lane 2, the scheme mentions a fee of 1 lakh rupees, and it is subject to the conditions that the value of the overseas asset does not exceed 5 crore rupees. Now I will be conservative here. The scheme table uses the wording a fee of 1 lakh rupees and ties eligibility to the asset value threshold. The detailed operational mechanics, including how the fee applies where there are multiple assets, should be read with the notified rules and official guidance once issued. So do not assume shortcuts like 1 lakh once for everything or 1 lakh per asset unless the final notified mechanism clearly supports it. Now the process, because this is not a casual declaration. You file a declaration in the prescribed form and manner. It is intended to be electronic process with electronic verification. The scheme is strict about correctness. If any material particular is found false at any stage, the declaration can be treated as invalid. If scheme conditions are violated, the declaration can be treated as invalid. After you file, a designated authority passes an order determining what is payable. The order is to be issued within the timeline specified in the scheme. Then comes the payment timeline. The payment deadline runs with reference to when the order is received by you. It is not counted from when the order is issued. You pay within the permitted period. If you miss the primary period, the scheme allows an additional period with interest at 1% per month or part of the month, subject to scheme conditions. After payment, you intimate the payment details in the prescribed manner. Then the authority issues an electronic certificate order confirming payment as per the declaration. That certificate is meant to be conclusive for what it states. Now the big question, what do you actually get? If you make a valid declaration and pay within the allowed timeline, the declared income or the investment amount in that declared asset is not included in total income under the income tax law and under the Black Money Act framework to the extent provided in the scheme. And the scheme provides immunity from further tax, penalty and prosecution under the Black Money Act in respect of the income or asset so declared, subject to conditions. Please read that line again carefully. It is not a blanket immunity. It is linked to what you disclose and only if the declaration remains valid. Now the non-negotiable cautions. Amount paid under the scheme are not refundable. So do not rush into declaration without checking classification, valuation approach and documentation. The scheme does not apply to cases where the income or asset represents proceeds of crime and proceedings have been initiated or are pending under the Prevention of Money Laundering Act. The scheme does not apply where assessment proceedings have already been completed under the Black Money Act for that assessment year. If there are ongoing proceedings under the Income Tax Act or the Black Money Act for the same income or asset, the declaration is to be considered while finalizing those proceedings as per the scheme framework. Now let me come back to your practical NRI reality. If you are a pure NRI and not resident and ordinarily resident, Schedule FA is generally not your compliance burden for that year. That is why you should stop panicking just because you hold foreign assets. But the moment you become resident and ordinarily resident, foreign asset reporting becomes a serious compliance obligation. And that is why returning NRIs get trapped. They carry overseas accounts from their non-resident phase into their resident phase and then they miss these schedules. So how should you approach fast DS in a safe, conservative way? First, map your residential status year by year. Do not guess. Disclosure obligations change sharply when you move from NRI or RNOR to ROR status. Second, list every overseas asset and overseas income stream. Bank accounts, brokerage accounts, retirement accounts, stock awards, anything that gives you foreign financial interest. Third, identify the first year in which you became resident and ordinarily resident and check what you disclose in the return schedules versus what exists in reality. Fourth, classify your case honestly. If your case is truly about income not offered to tax in India when required or an asset where the source explanation is vulnerable, do not try to label it as a single reporting miss. This is exactly how declarations become invalid later. Fifth, check the scheme thresholds with discipline. 1 crore lane versus 5 crore lane. Do not force fit facts. Sixth, for lane 1, the valuation point is expressly linked to 31st March 2026 and fair market value in the prescribed manner. Seventh, wait for the notified dates, forms and rules and then file with full documentation. Because if the declaration is treated as invalid, you lose the protection and you land back in the normal law territory. Now a clean summary in plain words. Fast DS 2026 is a proposed one-time disclosure window introduced in Budget 26 to help eligible small taxpayers correct certain foreign income or foreign asset disclosure failures within strict limits. It exists in the shadow of the Black Money Act, where non-disclosure can have severe consequences. It is helpful only if you classify correctly, disclose fully, value correctly, and follow the process perfectly. If you are returning to India, please do not treat overseas reporting as a minor formality. In India, foreign reporting is a compliance trigger, not a courtesy. TAN versus PAN. Now coming to a major relief for NRI property owners selling in India or a resident buyer purchasing property from an NRI. This budget 2026 proposal removes a very irritating speed breaker because today one small technical requirement often delays the sale deed, the payment schedule and sometimes the entire deal. That one requirement is called TAN. Budget 26 proposes that the resident buyer may no longer need TAN for TDS compliance when buying property from a non-resident seller. Instead, TDS compliance is proposed to move to PAN-based challan mechanism. Very important. This is a compliance simplification, not a tax waiver. TDS still applies, rates still matter, documentation still matters. Budget proposals become final only after the law is enacted and the procedures are notified. Also, NRI property taxation depends on facts like holding period, cost, exemptions, certificates, treaty positions and paperwork. Now let me tell you what the real pain is today. Today, if the seller is non-resident, the buyer is suddenly forced into a mini tax compliance project because the buyer must deduct TDS and comply under withholding provisions. And for that, a normal one-time buyer is expected to do things they have never done before. Apply for TAN, deposit TDS under TAN, file the relevant TDS reporting, and make sure the seller actually gets credit for that TDS. So a buyer who is simply purchasing one flat in their lifetime is forced into a compliance workflow meant for businesses. That is why NRI property deals face execution delays. Not because people want to avoid tax, but because they get stuck in the process. Now let me simplify two terms that sound similar but are very different. PAN is your tax identity number. Most individuals already have it. It is your permanent ID card in the income tax system. TAN is a tax deduction and collection account number. It is typically for people or entities who regularly deduct tax, like employers, companies, firms, banks. So, in a property purchase from an NRI, the law currently pushes even a normal buyer into the TAN world, and that is the friction point. Now, to the actual proposal in Budget 26. Budget 26 proposes that if the seller is non resident and the buyer is a resident individual or resident HUF, then the buyer will not be required to obtain TAN for this transaction. Instead, TDS compliance is proposed to be done through the buyer's PAN based challan. This is proposed to be effective from 1st October 26. So the clean message is this: from 1st October 26, a resident individual or HUF buyer may be able to deduct and deposit TDS using PAN based reporting without TAN. And I am using the words may be able to deliberately because the law and the official guidance also say that the challan cum statement format and the process will be notified later, meaning the exact form and workflow will come through rules and notifications. So legally this is the correct position. The finance bill proposes removing the TAN requirement for this buyer category for this transaction effective 1st October 26, and the operational how will be notified later. Now let me clarify the scope because many people will overgeneralize this. This relief is clearly meant for resident individual buyers and resident HUF buyers. It is not automatically meant for companies, firms, LLPs, or other buyer categories. So, if a company buys property from an NRI seller, this relief may not apply unless separately notified. In short, this is primarily meant to help ordinary resident home buyers. Now, the most important section: what does not change? Many people will misunderstand this and assume the whole TDS problem is solved. It is not. TAN removal simplifies the compliance route. It does not change the core withholding obligation. So, what remains the same? 1. TDS is still required. If the seller is non-resident, the buyer still has to deduct TDS at the applicable rate. 2. Wrong TDS can still create trouble. If you under-deduct, you can face interest, notices, and follow-up compliance. If you over-deduct, the seller's refund process can become painful and slow. 3. Capital gains computation still matters. This proposal does not say deduct only on capital gain or deduct only on sale price. That question still exists and it is at the heart of most disputes in NRI property sales. So yes, TAN removal is a big relief, but the math and the proof still matter. Here is a simple analogy to make this memorable. Today, a resident buyer purchasing from an NRI is forced to get a commercial driver's license just to drive one trip. That commercial license is TAN. Budget 26 is saying for this specific one-time trip, your regular driving license, which is your PAN, should be sufficient. That is all. But the traffic rules still apply, speed limits still apply, and the fines still apply. So only the license requirement becomes simpler. Now let's talk about the real practical impact. If you have handled NRI property deals, you know the timeline stress: token money, agreement, installments, final payment, registration date fixed, bank transfer windows, sometimes power of attorney complications, sometimes buyers' local disbursement issues, and then suddenly someone says, TAN, where is TAN? TDS deposit, how will we do that? That one line can postpone registration, or buyers start negotiating discounts, or sellers get nervous about payment release. So, if PAN based challan replaces TAN based compliance for resident individuals and HUF buyers, the transaction becomes smoother, not because the tax is reduced, but because the compliance entry barrier reduces. Now, what should an NRI seller do differently because of this change? This proposal mainly eases the buyer's burden. But as an NRI seller, you should still plan the sale properly. First, confirm residential status because for withholding that matters. Second, keep your PAN active and accurate because reporting relies heavily on PAN details. Third, understand whether your gain is long term or short term because that affects tax rates and exemptions. Fourth, plan the TDS rate early because the buyer will ask how much TDS do I deduct and on what amount. Fifth, where relevant, explore the lower or nil deduction certificate route. Sixth, coordinate installment dates with the TDS deposit steps. Even with simplified reporting, deduction and deposit timing matters. Now, what should a resident buyer do? If you are a resident buyer purchasing from an NRI seller, understand this framework. Identify that the seller is a non-resident early. Don't wait for the last day. Understand that withholding is the buyer's compliance, not seller's. So this is not a seller's tax problem from a compliance standpoint. Confirm what category you are. If you are a resident individual or HUF, the relief is proposed from 1st October 26. If you are any other category, you may still need TAN unless notified otherwise. Keep the documentary trail clean. PAN details, sale agreement, payment schedule, bank proofs, and do not assume 1% TDS like resident property purchase. Resident to resident property TDS is a different regime altogether. NRI seller withholding is a different regime and can be much higher. That mistake is the single biggest reason for trouble later on. Now, timeline clearly again. The proposal is effective from 1st October 26. So until that date, the existing system continues unless the government notifies something earlier. Meaning if your transaction is happening now or in the near term, do not assume PAN based challan already applies. Treat this as a future simplification useful for deals planned around or after October of 26. Now what happens next? The government will notify the challan cum statement mechanism. It will specify the format, the fields, due dates, and how the TDS certificate will be generated. Portals will be updated to allow PAN based deposit and reporting for this case. But until notified, do not claim that it will work exactly like Form 26 QB. The accurate statement is this: it is intended to work through a PAN based challan route and the detailed process is yet to be notified. So, what is the takeaway? Budget 2026 proposes removing the TAN requirement for resident individual and HUF buyers purchasing property from a non-resident seller. It proposes shifting compliance to a PAN based challan route. It is proposed to be effective from 1st October 2026, subject to enactment and notified procedures. This reduces execution friction, but it does not reduce tax responsibility. So if you are an NRI planning a property sale in India or a buyer purchasing from an NRI, plan the withholding and documentation early because that is what prevents last minute deal breakdowns. Now changes in TCS. Another key highlight from Budget 26 is the rationalization of TCS. The government has moved towards a uniform lower tax rate on certain type of overseas expenses. Two buckets matter for most resident families with NRI connections. One, money remitted abroad under LRS for education and medical treatment. Two, overseas tour program packages. Now pause here. LRS is a resident Indian mechanism. So if you are an NRI remitting from your overseas bank account, you are not using LRS route at all. But if your parents or family in India are sending money abroad for your education, medical treatment or travel plans, they are typically the ones facing the TCS. So what is the change? For education and medical remittances under LRS, TCS is proposed to come down from 5% to 2%. One important detail here, the 10 lakh threshold remains the same, meaning TCS triggers only once your LRS remittances crosses 10 lakh in that year as per the existing framework. Second change, overseas tour program packages. Earlier this was a two-step pain, 5% up to 10 lakh and 20% beyond 10 lakhs. Now the budget proposes a flat 2% for overseas tour program packages and it also removes the threshold. So 2% will be collected irrespective of the amount paid for the package. Now let me also define tour program package in plain English. The wording covers the tour package and related spend like travel, hotel stay, boarding, lodging and similar related expenditure. So don't reduce it to only flight tickets or only hotel. It is a defined category and the seller who falls under that category collects TCS. Now the most important line, and please don't miss it. This is only a cash flow relief, not a tax exemption. TCS is like a refundable security deposit collected upfront. It gets reflected in your Form 26A or AIS and generally becomes available as credit when you file the income tax return for that year. So the pain was never I lose the money forever. The pain was my money gets blocked upfront. That is what this change addresses, and yes, practically it is meaningful. Let me give you a simple number example. Assume a resident buys an overseas tour package of 12 lakhs. Earlier 5% on 10 lakh was 50,000 and 20% on next 2 lakh was 40,000. The total TCS collected upfront was 90,000 rupees. Now at a flat 2% of 12 lakh is 24,000 only. So the upfront outflow reduces by about 66,000 rupees. That is real liquidity in the traveler's hands. Now one trap I want you to avoid. Please do not walk away thinking LRS TCS is now 2%. No, only education and medical treatment remittances under LRS move to 2%. For LRS purposes other than education or medical treatment, the 20% rate remains unchanged. So if the remittance is for other purposes like certain kind of investments, gifts or anything not tagged as education, medical, the higher rate framework can still apply. So the classification of purpose matters. This is where mistakes happen. If the remitter gives the wrong purpose code or description to the bank or assumes that any foreign payment is education because the child is abroad, you can end up with the wrong TCS being collected, and then you get stuck chasing refunds and reconciliations. Next, the effective date. These changes are proposed to take effect from 1st April 2026, meaning they apply from tax year 26-27 onwards as per the post budget clarifications. So for payments made before 1st April 26, the older rate structure may still apply. Now, from an NRI family angle, this change is relevant because many NRIs depend on resident parents for outward remittances for tuition fees, living expenses, medical emergencies, or travel. Lower TCS means less upfront blockage, but it does not remove reporting, it does not remove documentation, and it does not convert a taxable situation into a non-taxable one. It only reduces the upfront collection. If you are planning a large remittance for education or medical expenses or a large overseas travel payment, plan the timing, check the purpose classification, and keep records clean. That is how you actually benefit from the change without future headaches. This is a technical area and facts matter, so treat this as educational guidance based on the finance bill and post budget clarifications and apply it to your facts before acting. MAT relief for NRI. Now coming to the next change. This budget we heard a very simple line. MAT exemption for non-resident Indians who pay tax on presumptive basis. But in tax, simple headlines often hide very complicated conditions. So let me decode it in plain language. First, what is MAT? MAT is the minimum alternate tax. Think of it like this. A company may show low taxable income under normal provisions, but it may still show healthy profits in its books. MAT is the tax law saying if your books show higher profits, you cannot pay zero or near zero tax. So MAT is a company concept, not an individual concept. So if you are an NRI individual earning rent, interest, capital gains, this MAT change is not aimed at you. Now what is presumptive taxation in this context? Presumptive taxation is when the law does not ask you to compute actual profit. It says we will assume a fixed profit percentage and tax you on that. So instead of a full detailed profit and loss calculation, you get a formula based tax liability. Now comes the real issue. If the law already taxes you on a fixed presumptive basis, should you still be dragged into MAT based on book profits? That was the mismatch. And this budget is trying to fix that mismatch for certain non-resident businesses. Here is what the finance bill proposes. Under the Income Tax Act 25, MAT is in section 206. There is a specific carve out where MAT does not apply to a foreign company if its total income consists only of profits from certain specified non-resident businesses and that income is offered to tax at the presumptive rate specified. Now the catch. Till now, that carve out applied only to some items in section 61 subsection 2 table, specifically serial numbers 1, 3, 4 and 5. That meant two types of non-resident presumptive businesses were left out, even though they were also presumptive. And those two are exactly what Budget 26 brings into the MAT exclusion umbrella. One, operation of cruise ships. But note this carefully. Cruise ship presumptive taxation is subject to prescribed conditions. So the exemption is not a blank check. You must satisfy the conditions once the rules are checked. 2. Business of providing services or technology in India for setting up an electronic manufacturing facility or in connection with manufacturing or producing electronic goods, provided it is for a resident company. So the core change is this: the MAT non-applicability is being extended so that the remaining specified presumptive businesses under section 61 subsection 2 also get covered. In simpler words, if the law is already taxing that foreign company on a presumptive basis, the law should not simultaneously say, now also compute MAT on your book profits. That is simply the logic. Now, who should care? If you are a foreign company or you run a structure through a foreign company and your India income is only from one of these specified presumptive businesses, this proposal is relevant. Cruise ship operations or specified electronics related services or technology to a resident company, and also the other already existing presumptive brackets in the same table, like shipping other than cruise ships, aircraft operations, turnkey power projects, construction, and service for mineral oils. But there is one phrase you must not ignore: total income comprises solely of these profits. Solely means only. So if the same foreign company also has other India income, say interest, royalties, fees, anything else, the clean MAT does not apply story can get complicated. That is where people make dangerous assumptions. Also, remember the timing. This is a proposal in the Finance Bill 26 and it is stated to take effect from 1st April 2026, meaning tax year 26-27 onwards, subject to the bill being enacted and the final wording of the law. So, this is a targeted MAT relief and not a generic NRI tax relief. It mainly matters for foreign companies in specific presumptive business lines, especially cruise ships and certain electronics manufacturing work, which were earlier not covered by the MAT carve out. That's the change. Baggage rules. Beyond the tax slabs, budget also introduced the baggage rules 2026. It also quietly changes how customs treats you when you travel to India, especially if you are an NRI returning, relocating, or just bringing gifts and gadgets for your family. Let me simplify this. Think of customs like airport security plus a billing counter. If you declare correctly, you pass smoothly. If you assume it's personal, so it's free, that's where problem starts. After Budget 2026, India has rolled out a fresh baggage framework. The Baggage Rules 2026 are effective from 2nd February 2026 itself. Along with this, Customs is pushing a more digital app-based process for declaration and payment. So I'll break this into 4 practical parts: duty-free allowance, digital declaration, transfer of residence for returning NRIs, and personal imports or gifts sent to India. First, a duty-free allowance. That is the most misunderstood part. If you are a resident or a tourist of Indian origin or a foreigner holding a valid non-tourist visa and you arrive into India by air or sea, your general duty-free allowance is now 75,000 rupees. This is per passenger and it is not for infants. If you are a tourist of foreign origin arriving by air or sea, your allowance is just 25,000 rupees. Again, not for infants. Now the big trap. If you are arriving by land route, there is no general duty-free allowance. Many people get shocked at land borders because they assume the same benefit applies. It does not. Second trap. That rupee 75,000 or rupee 25,000 does not cover everything. Certain items are specifically excluded from general allowance. For example, firearms, certain quantities of tobacco and alcohol, gold and silver other than ornaments, and televisions. So even if you are within 75,000 rupee overall, these categories can still trigger duty. Also remember this: customs looks for bona fide baggage, personal use quantities, not commercial looking quantities. So if you carry 10 phones for cousins or multiple identical gadgets, you already know how that story ends. Now the second part, app-based and digital declaration. Customs has formally enabled electronic filing through the system, including IceGate and the Atithi web or mobile app. The direction is clear: declare digitally, process faster, reduce manual discretion, and collect duty smoothly when payable. There is also a practical convenience here. You can file an advance baggage declaration up to 3 days before arrival. So if you know you are carrying dutiable items, it is smarter to declare upfront than to argue at the counter after landing. My practical advice is simple. If you are carrying high value items, keep invoices ready. If you do not have invoices, be prepared for customs valuation and never hide and hope. With digitization, risk selection becomes sharper, not softer. Now coming to the third part, transfer of residence. This is specifically relevant for NRIs who are relocating and returning with household effects. Transfer of residence is not a casual benefit. It comes with eligibility conditions and value caps. And the new rules try to make it cleaner and more standardized. Broadly, the benefit depends on how long you have stayed abroad and your travel pattern. If you have stayed abroad for 3 to 12 months, there is a limited duty free benefit up to rupees 1.5 lakh for eligible household and personal articles, subject to conditions and exclusions. If you have been abroad for at least 1 year during the preceding 2 years, the benefit goes up to 3 lakh rupees with an important condition. You should not have availed transfer of residence benefit in the preceding 3 years. If you have been abroad for at least 2 years, the benefit can go up to rupees 7.5 lakhs subject to stricter conditions. One key condition is about short visits to India. If your local stay in India on short visits during the preceding 2 years exceeds 6 months, the eligibility can get impacted. And the not availed in preceding 3 year condition is a hard condition. Another practical point, for certain appliances and electronics, there is a one unit rule, meaning even if you qualify for transfer of residence, you cannot bring multiple units of the same category under the concession. So plan your shipment list properly. Don't do it in a hurry on the last week of the relocation. Now the fourth part, and India's favorite, jewelry. This is a sensitive topic and people circulate half truths very confidently. Under the new baggage framework, for an eligible passenger who is a resident or tourist of Indian origin residing abroad for more than 1 year, there is a duty-free jewelry allowance linked to weight. For a female passenger, up to 40 grams. For a passenger other than female, up to 20 grams. Please notice what I did there. I said weight, not value. Also notice the eligibility condition. Residing abroad for more than 1 year and on return to India, if you don't satisfy the residency abroad condition, don't assume the jewelry allowance is available. That assumption is what converts a happy landing into a long discussion at customs. Now the last part, which many NRIs confuse with baggage, personal imports and gifts shipped to India. Budget 2026 has also reduced customs duty for certain personal imports or gifts under a specified tariff category. This reduction is effective from 1st April 2026. The rate is reduced from 20% to 10% plus applicable surcharge components as per the law. But this is important. This is not your passenger baggage allowance. This is relevant when you are importing personal use items or sending gifts to India through shipping or courier channels. So don't mix these two concepts. Now let me summarize this in one simple line. Budget 2026 is pushing customs towards three things: higher clarity, more digital declarations, and more uniform enforcement at the ground level. So what should you do as an NRI traveler or returning NRI? Before you fly, do a 60-second check. How are you arriving, air or land? What are you carrying, general goods or excluded categories? Are you relocating, yes or no? Do you qualify for transfer of residence? And do you have documentation for high value items? If you follow this, the experience becomes smooth. If you rely on WhatsApp forwards like nothing is taxable now, customs will give you a practical lesson at the airport. This explanation is purely educational and based on the notified custom baggage framework effective from February 2026 and allied post budget changes. So what is the clear takeaway from this? It is this: the rules of compliance in India are getting both sharper and simpler, but the responsibility remains entirely yours. The government is simplifying the process with PAN-based challans and reduced upfront TCS, but they are also hardening the consequences for non-compliance, particularly around foreign asset disclosure. The 5-year tax exemption is only for specified class of professionals under a notified scheme. Fast DS 2026 is a high stakes one-time chance to clean up foreign asset reporting, but only if you classify, value and document correctly. The TAN-PAN relief simplifies property transactions, but the core obligation to deduct the correct TDS rate still applies. Baggage Rules 2026 offer clarity but demand honest digital declarations. In the cross-border world, small mistakes create big headaches. By following the guide, you can ensure that the Union Budget 2026 works to your advantage, not against you. If you have any doubts or questions, feel free to leave a comment. This is the Offshore Advantage. See you in the next video.